Let's have a chat about your profit margin and how that affects your business. This is the most crucial part of your profit and loss. It's the top section. It's where your income is and your cost of goods. Everything else is your overheads, your fixed costs. You can't do too much about them on a day-to-day basis, or at least you shouldn't be able to. They should be quite fixed and regulated to what you need to run your business. Your profit margin is directly attributed to the product or service that you sell. So everybody has a product. Even if it's a service that they are the product or their team are the product, where you're charging hourly rates as a professional service, or you have a physical product that you're selling. Every business pretty much is run off a product being sold. So in saying that, we need to work out, what does that product cost you to sell? So there's a few things that you need to consider. And I'll be quite broad in some aspects because, as I said, products are varied business to business. So if you physically buy that product and on-sell it, or buy that product, change it a bit, add to it, then sell it, there's some costs there. You've got your physical costs that you started with. That's quite easy to calculate. What's it take to get to you? Did you have to pay freight with it? Have you done anything with it? Have you stored it, changed it, added to it, packaged it, and then on-sold it, and freight included to on-sell it out? They're all costs that you want to know. What is that cost? Is it the same for every product? Is it the same, more importantly, every time you sell that product? Or does it change every time that same product comes into your business and out? They're quite critical conversations you got to have. If you've got varied costs every time on the same product, that's not too good. It can still be managed. You just got to understand why and how to manage it. Often the same product could cost differently if it's in multiples. If you're selling numerous of the same product to one person or one customer, or if you're buying them in bulk as opposed to buying them individually, that price is going to change as well. So there's a lot of variables here, a lot of calculations to say, is it cheaper and more profitable for me as a business to buy more of that product rather than less? But in buying more, I need more capital. I might need more storage. Freight's going to be more expensive, or is it going to be cheaper overall? These are all the calculations once again. This is where the fun starts. See how there's so many things involved, so many moving parts, but this is what gives your output, your figures, your cost of your product, which is crucial. Because if you don't know that, if you don't know all those variables, those what ifs, what if I buy 10? What if I buy 100? What will freight be on 10? What will freight be on 100? And then break that down reverse to per product. How do you know what you're going to sell it for? Are you selling it just at market rate or what your competitors sell it for? Or are you selling it with a dedicated 30% markup, 100% markup, 2% markup on what it costs you? It's crucial to know that and have those spreadsheets and those calculations in front of you. Otherwise, you could be losing money on every product without even knowing. So what you need to do as a business budget, if we take it back a few steps, is you need to work out what your fixed costs of your business are. You know that, you know what profit you need to make each month, if we talk monthly, to stay afloat, to pay your wage, pay your profit. You work out your product cost and what your profit per product is or service, and then you calculate, okay, if I need to make X amount to cover my fixed costs, I need to have a margin of X amount, which will give me a certain dollar figure as profit if I can sell 100 units, 200 units, 2 units. And that's how you do these calculations and scenarios to work out what's reasonable. Is it reasonable to sell 200 units? Or is it only reasonable to sell 5? And if you can only sell 5, but you want to achieve 10, and I'm using all these different numbers because it shows examples of smaller numbers or bigger numbers, and volume makes a big difference. How many do you need to sell to make that profit on your products to cover your overheads? Simples in some ways. Simple theory, difficult to calculate. It's complex, it takes work, it takes figures and understanding. And a lot of businesses, this is in the too hard basket. So they just wing it and go for it. And if the bank balance is right, they're winning. Not really. If you're getting value from this video, give it a thumbs up. Otherwise, you can also share it with someone who you think could get value out of this. You can't always price your products on your competitors or market value. That doesn't always work because everyone's costs are different. You don't know what your competitor is buying those products for. You don't know what other add-on costs, direct costs or fixed costs they have. You don't know what wages they're paying themselves. You don't know their home loan. At the end of the day, that affects it. So you can't really compare yourself to your competitors. You need to work out your figures. And that's it. Then you have your long-term views or mid-term views of goals of products and what's reasonable to sell. So that's just for one product. Now, we can lead into different products. You might have 5 products, 500 products, 1 product. And I said that product might be a service. It might be your hourly rate. You might be a lawyer, an accountant, anybody who's charging a product being a service. You need to know how many hours does it take of staff time to produce that report, that output. What's the charge out rate? What's the cost of those employees? Not just your wage cost. It's their superannuation, your work cover. What's the rent for their desk, their computer, their Friday Friday lunch that you buy them. All those costs come into that cost of that employee to work that hourly rate to give that output. So that's a product cost. Whether you want to attribute it traditionally or not, it's a product cost. And that's how you then determine what's your margin, what's your markup on that product. What are you selling it for? Is that sufficient to cover your costs? Now, it's okay to have a smaller margin on some products and big margins on others. That's a good business in some ways, some people might say. Everyone's got their own opinion, so I'm not going to go down that path. My opinion is if you've got diversity in your products and you don't just have one product, then you're going to be a more successful business because you've got more ability to be flexible with market conditions or market demand. Now, that could be federal economic, or it could just be to your industry and your demand. But if you've got flexibility, then you're going to be a more successful business because you can move with the times. So if you've got some products that might have low margin, and that low margin might be for several factors. First of all, even though I did say before, don't base it on your competitors. You might purposely, strategically have a lower margin so you can have a lower price as an entry to get people in the door, or as an add-on. So you might have your main product and then have an add-on and the add-on might have a lower margin, but you're doing that for value add to your clients because a small margin is better than no margin, but it's an easy sell. So there's different ways to apply it there. You may also have low margin or no margin, being a loss, on purpose to get the client in the door. But once again, this has to be really strategic to know whether if you're going to make that loss on that product, are you guaranteeing yourself that you're then going to have another product behind the door that your client's going to buy that is going to have a margin on there to make up for that loss? Or is it ongoing services? So your upfront initial consultation or setup fee might be a loss, but you're agreeing to that if they've signed an agreement and a contract for 12 months worth of recurring services that there's a certain margin on. Then overall, as a client, you're winning out of them and your margin's there. But you wouldn't just give away loss-leading products. You might. That might be your marketing ploy and put that down as a marketing expense, but at least know that it's loss-leading and you've got a low margin on there. Some other products might be high margin. They might be one-off or rare products that you might be able to sell. Or that might be the majority of your business is high margin products, which is great. It's great business, obviously. The main point of this is knowing those products, knowing what your margin is, identifying them, having those strategic conversations with your team or management, whoever is on your team, more importantly with yourself to start with, and identifying what products do you sell, what margins on them. Can you change that margin? Do you want to change that margin? Because yes, you can change the margin by having a lower cost of that product, by buying cheaper or changing what you do to it, but you might not want to because that then compromise the quality of your product. So they're business choices. Not every product and service that everybody sells in the world is of high quality. Some are cheap on purpose. So determine where your product sits in the market, where you want it to sit, determine that margin and that cost and what you want to do that product, if anything, to sell it, and then what your sale price optimally is. Those are all factors that help you determine that process of what is your product cost, and then it rolls into what is your gross margins, what is your gross profit in your business. So there's quite a bit of information there about products, margins, and why it's important. As I said, it's very specific to your business and it's a bigger conversation and a bigger piece of work that needs to be had. For now, the conversation needs to be started. And at least if out of this, I can challenge you to say, do you know your margins? Are you confident with your products and be able to say straight away, yes, these products are my loss leaders. These are my small margin products. These are my high margin products, but also these are my high selling products. Biggest challenge as a business owner is knowing your products, and knowing the margin is part of knowing your products. So that's what I want to achieve out of here, is just to challenge you as a business owner in that field. We can have a chat, or you can have a chat to your accountant about how to calculate these or how to refine them, or make sure that you've got the right costs in there, because that's important. And there's no right or wrong answer. It's what works for you. What you want to attribute to that product as a cost is up to you. There's no rule book. There probably is, but theoretically, it's up to you as a business owner. Let's have the chat. Open the conversation, start to know your numbers once again, and know your product costs and product margin. If you liked this video, I think you'll like this one too. Check it out.